Welcome to a Wiser Retirement Podcast. Before we get started with the episode, I wanted to let you know about a new free ebook available on our website. This ebook goes over the top reasons most financial plans fail and covers what a quality financial plan should consist of. The link to download Top Reasons Most Financial Plans Fail is listed in the episode notes. Now on to today's episode.
Welcome to a Wiser Retirement Podcast. We believe the best of financial advice should always be conflict-free. I'm your host, Casey Smith. Joining me today is our co-host, Brad Lyons. Hey, Brad.
Hi, Casey.
Today we're going to talk about strategies for managing risk in a portfolio. But before we get started, Brad and I always have our little tangents here before we get up. First of all, we have a lot of new listeners, so welcome to the podcast. Man, what are we up to now on number of recordings? Is it one? Do we know?
48, I think it was.
Yes, 148, right here in front of me.
How about that? Yeah.
Episode 148.
But this is beginning our fourth year, I think. We're beginning our fourth year or third year? Beginning our third year. Okay.
So anyway, Brad is in charge of investment management here at Wiser. He also talks to a lot of prospect clients on my behalf. And I am the lead advisor and president of Wiser Wealth Management. We also have a great team with Missy and Michaela. Missy's a senior advisor. Michaela is a planning associate. So a lot of people have been working with them here in the last few months as I gravitate more to podcast and writing.
Yeah.
The writings will get a lot easier though, Brad. Have you heard of Chat GPT?
Well, it's something that's kind of hitting the landscape here recently.
Yeah, if our listeners haven't heard of Chat GPT, you need to start Googling this as I'm talking or something, because this thing's amazing. It's developed by OpenAI. I think it's like version 3.0 of artificial intelligence. And I got a subscription a while back. I listened to a podcast. It's called the All In podcast. And David Sachs, one of the hosts, was talking about this Chat GPT. And so I was like, I haven't heard of the thing. It sounds really cool. So I go online to find OpenAI. This thing's crazy. It's crazy. I created a, it's text-based, language-based interaction. You can pretty much ask it anything. So you start off with really simple stuff. It doesn't know sports scores. But you can start off with, what's the capital of France? And it'll just tell you the answer. And that sounds pretty cool. I mean, Siri can do that, right? But this makes Siri look like an uneducated fool compared to what this thing can do. I said a couple of things. One, a while back ago, I said, Chat GPT, write me an article about the benefits of fiduciary fee-only financial planning versus other forms of financial planning. And it wrote this whole 500-page report on why fee-only planning is better for the client. And
that's because it's not querying against a single database, is it?
No,
it's querying against the World Wide Web. Right. So the World Wide Web is its database, whereas
Correct.
Other types of AI of this matter, where you're querying against it and getting back information, it's a single database.
And it's learning. I think there's over 2 million users right now. And so it's learning. In fact, my son, I told my kids about it over dinner, this is probably a couple months ago. And they were like, so it can write papers.
Everybody has their angle.
And then, my daughter, her next question was, does it source? And that's actually what it doesn't do. It doesn't tell you where it got the data from. So that's kind of
because on the World Wide Web, theoretically, nobody owns the data. In a sourcing situation, you're sourcing a source, okay, that owns the data. Okay, a paper that was written by a scientist or something,
True. But I guess you kind of want to know. I mean, if it came from like TMZ.com versus the Wall Street Journal, I'd kind of like to know that I probably would discount half of what TMZ said, right? So I would like to know the difference. But for this episode, we won't read through this, but I said ChatGPT write write a podcast script for 2 co-hosts covering covering what Chat GPT is. And it wrote out, you guys are watching on YouTube here. It wrote out a 2-page script on how we would narrate what Chat GPT is. It's just simply amazing. Our last episode covered 72T. I put a Chat GPT query in to write about what 72T is, and it just gave me pretty much the entire IRS code, but explained in plain language. You can talk in other languages, so you can translate. You can say, write an article in French about Chat GPT, and it would write it in French. The future is here. Quite honestly, for based on what it's learning and what it knows, they say robots were the replacement of blue collar workers, like on the assembly lines. Chat GPT has the potential of replacing white collar workers. The overlay, it can start answering emails for you. In our world, a client wants a withdrawal. Let's say they want to pull out $5,000 from their account. This is not in production yet, but it has the potential of sitting on top of your system and going, hey, you just got an email. I can take care of that. And let me check the account. Oh, there's no money in the account. Okay, well, I'm going to place this trade. Once the trade's done, then it could do all that for you and then send the client the money. It would be no human interaction whatsoever. It could be done flawlessly, no errors. So it's really amazing. I read something about in China, a robotics company is trying to take the Chat GPT language processor and basically put that into its robot. So its robot would have this intelligence built into it. You could just go on and on and on. The only thing that you have to be careful of is the data. Is the data accurate? So in some cases, I don't know that I would say it was 100% accurate, but it was vague enough that it could pass, I guess. But it's learning. And you can tell it. When you get a query back and you say, well, that's not quite right, you can alert OpenAI. And that's what the whole purpose is. I had to put my credit card in to use it. So at some point, this is going to be so
all the current users essentially what's called beta testers.
Exactly.
Okay?
Exactly.
And the owner, which is the investors and OpenAI itself, they're taking this information back and then bringing up, Chat GPT program to take into account all these queries that they could never consider because, they were a company of X number versus now 2 million beta testers. Right?
My understanding is this is so powerful that people expect it to replace Google search in the near future, which is kind of ironic because the U.S. government has just sued Google over advertising practices and making sure that they're their dominant browser. I'm like, it's probably old news. When I saw that, I was like, that's probably old news. I think, Microsoft just put $30 billion into ChatGPT or OpenAI as an investment. So obviously they're really big on it to put $30 billion into a single technology. My understanding, and we will need to fact check this, but my understanding is that Google has stopped working on their next version of their browser and has abandoned it completely and moved right to AI as their next target. So there could be several competing AIs that are sitting out there. But this is so
relating that to this financial planning and investment management. I mean, just think of the things that you could do for a client who comes in with a particular unique situation.
Yeah,
and you could query Chat GPT. Ask what the response should be, what the solution could be.
Yeah.
And then for investment portfolios, what's the best way to manage a best portfolio with these objectives? And put in a list of objectives, for example. Have it query the internet and bring that information back as a solution. Think how that can increase productivity.
Yeah, I'm going to try query right now live. I don't know if they can actually do this. What are the 5 top stocks with the lowest EPS, earning per share? I'll be doing an acronym and see. Let's see if it will generate. I don't know that. Yeah, it can't. It actually tells me to consult with my financial advisor. So we're not being replaced just yet, Brad. Yeah, I didn't think that it could do stock data searches yet, but that is free out there in the space in Google. So that'd be interesting to see how that evolves and who takes that. But maybe that's what the 30 billion is for.
Maybe so. Yeah.
Very interesting. All right, so OpenAI chat, Google that. Maybe even sign up, start putting queries in, or maybe show your grandkids. They'll think you're super cool and advanced, right? All right, so let's talk a bit about strategies for managing risk in a portfolio. I know what the answer is. I can give you the fast answer, but we're going to drag you through this a little bit. First of all, it's not hedge funds, but what are hedge funds?
Hedge funds are non-regulated investment portfolios, usually managed to an objective or a strategy. That strategy can be from anything to specific strategies such as short or long, alternative. It can be credit. It can be equity. It can be arbitrage. It can be multiple objectives. And they're not required to, be regulated by the Securities and Exchange Commission.
Or even disclose their holdings.
Correct.
You don't know what's in it.
You don't.
But there's an objective. Typically, you know what you're putting your money in for.
That's right.
Which is
an investment management style, which is the objective itself.
Which could be hedging a falling market.
Could be.
So you would buy a hedge fund because it theoretically could go up when the market was going down. Theoretically. But it doesn't always happen that way.
No.
And they're very expensive.
The fees on them are generally pretty high. Investors have to be accredited to be an investor, and generally what they're doing is they're investing literally into a limited partnership of some sort.
Yeah.
Okay, so they have to sign subscription documents, and they have to apply to deposit their money, and lots of other things, hoops you have to jump through. But as an alternative investment, this is designed to have a different return stream, or what's called a non-correlated return stream, to public investments such as stocks and bonds.
Right. So, typically there's some really big hedge fund managers out there. I think most notably of recent years, they haven't done anything stellar. I mean, some of them I think got caught in the debt crisis with emerging market bonds a few years ago. They played it right, but they played it too early.
Right. That can happen. Generally, their streams of returns are much more erratic than the public's, but their idea is that when there are major market fundamental shifts, that they try and get out in front of that, as you're referring to, and take advantage of it.
Right.
And then when the shift has occurred, they unwind the position and look for the next one. So they're not required to maintain any certain one strategy, but rather to have multiple strategies to take advantage of, dislocations in the marketplace.
Then there's the private equity, but private equity typically you would think is being contrarian to stock market. It's really more of real estate, business investments, long term. I don't know if there's any private equity funds that are built to be hedges.
No, they're not hedge funds, but rather they're investing in businesses. They're privately owned businesses.
Correct. Hence the name.
Hence the name. But also the way that they're valued and priced, they're priced on a periodic basis rather than a minute by minute or day by day basis. So literally, private equity funds are pricing themselves at the end of each quarter, and then again at the end of the year, of course, doing a true up of the past year. So you're only getting a price 4 times a year on that investment. So one of the things that it does in a portfolio with publicly traded investments is it lowers the volatility simply because the price movement is less. Okay.
Yeah. We get a debate about that. We could have a whole episode on private equity. I don't know that that's the best place to hedge your portfolio. I think you're looking for outsized gains there.
Well, it's not a hedge. Again, it's a diversification.
Correct.
Yeah.
Correct. So if we're trying to manage risk in a portfolio, I don't think we're going to a private equity fund for risk management.
Maybe not. It depends on the size of the portfolio, though, too.
Yeah, that's true.
Right.
That's true.
Yeah.
Yeah, I think for most investors,
Because again, they have to be an accredited investor, which by definition, they're going to have larger sums of assets.
Correct.
Yeah.
But yeah, that wouldn't be a go-to for managing risk. Real estate, that's not a bad place to manage portfolio risk.
Real estate in the private sense. Mm-hmm. Yes.
Not your home.
Yeah. Not your own home, but but private real estate is a great way to manage the risk of volatility in your portfolio.
Yeah. And so I don't know. I go back and forth with that. I mean, that is true, but you don't value a home. Now with Zillow and Redfin, you can get the value of your home. I get an email every week or every month about the values of my home. And it's fluctuated by $50,000 to $100,000 in the last couple of months. But prior to that, you just kind of had a gander of what your home might be worth. And when you put it up for sale, then you get a real value at that point, because that's when a buyer and you, the seller, agree to a price, and that's essentially what your home is worth at that particular time. So the reason why it looks better in a portfolio typically is because you're not valuing it every second like you would a stock.
That's right.
Where there's continuous buyers and sellers on both sides. So I'd say it's a little bit of a false sense of security, but the whole market moves that way in real estate, where they're not buying and selling on a constant basis, the same house over and over again.
Right.
Right. So it does create some stability. It also can generate income potentially. And so you see the income coming in every single month that's being generated. But stocks do the same thing.
Through dividends.
Right. So there's a lot of similarities. Also, if you go into a panic and you're like, oh my gosh, I can't take this anymore, I'm going to sell my stock, you can sell it in a nanosecond, where your home you have to put a sign out in the yard. You got to paint the thing.
The language there is like, it's liquid. Stocks are liquid. Okay.
Right.
Stocks are also marketable. Your home is marketable, but it's not liquid.
Correct.
Okay. You can't convert it readily to cash. Over time you can, but it's marketable. There's somebody out there who wants to buy
Correct.
your home.
For the right price.
That's right.
Same with the stock. At the right price.
Instantly.
Right. Correct.
So when talking about risk, there's different kinds of risk that we should bring up a little bit.
Yep.
There's risk of inflation, purchasing power reduction in a portfolio. There's the risk of volatility in your portfolio. That is the ups and downs in the market and the portfolio as it responds to the pricing in the market.
Right.
But the big risk, and this is the risk that we talk about in financial planning, I think, is the risk that your portfolio and your financial plan don't meet their objective.
Yeah.
Okay. So it's really setting the objective and then managing the portfolio to that objective. And the risk is making sure that you don't miss the objective. And so there's a couple different objectives that we look at, and we manage risk to those objectives. Here at Wiser Wealth with Client Money, there's one of the objectives is living to age 95 and outliving your money.
Right.
So there's the risk of running out of money. Then there's the risk of not having enough cash flow to meet your objectives annually in retirement. Okay. And so on. So these are all different types of risks that we're creating strategies toward mitigating the risk of it occurring.
Well, ultimately, all right, let's go back. This quarter, our theme is financial success is intentional. So in order to be intentional, you have to have a plan. You have to know when your feet hit the floor in the morning, you have to know what your purpose is. And so a lot of people, when it comes to portfolio management, only see gains and losses, but we don't see it that way. We see the long-term objective is to hit age 95. So if we're managing risk for inflation, then we're going to be willing to take on more volatility, which is risk, because we know that in the long term we'll achieve our objective.
Right.
So it's how you come at it, understanding that dividends are going to keep coming no matter what the price of the stock is, right, or the index. So you can't set up a strategy that says, okay, I'm willing to make money, but I'm not willing to lose any money.
That's right.
That doesn't exist, but it's what everybody asks for. Everyone says, well, I'm okay with a 20% rate of return, but I'm not okay with a negative 20% rate of return. Well, it doesn't work that way. You can have plus 10 or minus 10, or, right? You can get the upside. You can always capture the upside with stocks. But bonds help us protect the downside until couple times of the year it doesn't, which is what just happened in this last year.
Right.
So I think we're going down through our checklist here. I think that's the next one is, okay, market timing. That's not a good way to manage volatility. You don't want to be buying and selling based on what the market's doing. That doesn't make any sense.
No, it really doesn't. It really doesn't, because you're taking away one of the greatest benefits you have as an investor, and that is time.
Right.
Okay. So the longer the time frame is, the greater the chance of you achieving your objective with a properly constructed portfolio. So time is a way to manage risk. Okay. And matching the portfolio to the length of time. So if we have a short time frame, we're managing it with very short duration types of investments or even cash to meet the objective in the short term. But when we're looking at making sure that somebody doesn't, run out of money until age 90, 95, so they retire at 65, we're looking at a 30-year time frame. That's a significant amount of time, and the portfolio is constructed in such a way to utilize that that risk management system of time to match the objectives. Okay.
So ultimately, I'll just say it. I think the best hedge in a portfolio, if you're not comfortable with the volatility, is short-term U.S. Treasuries.
Could be.
Tell me I'm wrong, Brad.
Over long periods of time, taking those, Treasury payments as income or reinvesting them to produce larger income, it does reduce the risk of volatility in the portfolio, but then there's that risk of inflation.
Oh yeah.
And so we know that inflation, treasuries either only keep up or don't quite keep up with inflation. So the risk of purchasing power is lost.
In its purest form, you could just buy the S&P 500, you'd be just fine. But psychologically, we can't handle that in years like last year.
Right.
Or even the COVID drop. That would have been very nerving to see your portfolio drop by that much. So what we do is we have to add something to the portfolio. So we diversify, there's some foreign, there's some small cap, but mostly we hold S&P 500. But if when we start adding treasuries, the volatility comes down, but so does the rate of return. So you lower your downside by adding treasuries, but you also lower your upside. So you get this band in something that you're comfortable with. I'm comfortable gaining 10. I don't want to lose more than 15 or 5, right?
Right.
And so that's the best way to manage risk, in my opinion.
So we're managing
the cheapest way for sure.
Exactly. So we're managing the risk tolerance, the tolerance for risk.
Correct.
For our clients.
But then you have to take that model and then you have to put it into your plan and go, okay, if I manage a portfolio this way, does it allow me to hit my objective at age 95?
Right. And if the tolerance for risk is different from what's required,
right,
that's where the conversation has to take place. Okay. And we can either match that or not. Then there's other things that we can do. Save more or spend less.
Yeah. Correct.
Yeah.
Well, there's also other part to it also is you have to understand, some people are using this in their marketing. It's they call it the bucket system. And so they have multiple buckets. And so you have your money you need now, the money you need in 3 years, 5 years, 10 years, and then 10 plus years. We do the same thing. We don't advertise it this way. It's really just 3 buckets. The 5 bucket system, 3 of those buckets are the same bucket, really. And you're shortchanging yourself if you can't move money in between those buckets. I'll explain that in a minute. But basically, you got to have 2 years worth of expenses in retirement. That's in cash or in something that's almost like cash. Then you have your bond portfolio, which is probably get you through another 5 years, if I had to guess, at least. And then you have your stock portfolio. You'll never touch the stock portfolio. Shouldn't. If you do, you're like 95 years old in a nursing home. It's that simple. And stop trying to second guess Jay Powell and all these other these people that are poking at our portfolios right now, right?
Yeah.
It's really that simple. Just maintain enough cash. You could even probably eliminate bonds. You could just hold 5 years worth of expenses and leave the rest in dividend paying. Well, I don't want to say dividend paying stocks, but stocks that are all paying dividends that go into the portfolio.
That are being reinvested.
They're being reinvested.
Yes,
that's it on the simplest form.
Right.
The
thing is that human behavior and investor behavior won't allow that.
No. It won't. It won't at all. And we get those phone calls. People are nervous, but I think this is where the role of advisors come in. Now we're talking about Chat GPT earlier. This is what Chat GPT can't do for you, is comfort you. And I think that's part of our role is we set this process up and say, look, this is about as cheap and as foolproof as you can make a process, and you're going to have to trust it. So we talk people off the ledge. So what's our solution? Short-term treasuries, maintain cash for at least 2 years, keep stock, and then we'll come and pat you on the back when times get tough.
That would be ideal. Okay. What's interesting though is that that how people react to the short term, even though when we've talked to them about the long term. Okay, it's just the way we feel. It's our gut reaction
right.
to the economy. We talked a little bit about in the last podcast. We don't invest in the economy. We invest in stocks. But they hear about the economy. Right. It's very rare that people hear about stocks other than watching CNBC.
Yeah.
They hear about the economy.
Or they hear about it on mainstream media. It's usually the Dow. I'm like, does anyone actually pay attention to the Dow anymore? It's all in the S&P. Yeah. I don't know why people don't get that. No one really invests in the Dow.
People should understand why we choose the S&P. The S&P is comprised of the 500 top U.S. companies that are all profitable.
Right.
There's a profitability screen in the S&P 500. So all 500 of those companies were profitable over the last 4 quarters.
Right. Exactly.
So how can you get any better than that?
No, you can't. You can't. I often think to myself, why don't we just all invest in the S&P 500 and leave everything else out? But there are other asset classes that perform well long-term. Real estate's one of them.
They do it. And when you blend different asset classes together, to your point earlier, you actually can reduce the risk of the portfolio without giving up as much gain as you would think. So adding bonds, treasuries in particular, to stocks actually can increase the return and decrease the risk at the same time. Now, it has a diminishing effect.
Correct.
Okay. But nonetheless, these are techniques strategies can be utilized in order to reduce the risk of a portfolio and trying to maintain its objective.
That's what modern portfolio theory is. You're always you're taking the baseline, which is the S&P, and you're trying to add and subtract to that to get the highest rate of return for the least amount of risk.
That's right.
I mean that's it. Money management in its purest form. It reminds me of I had a prospect come in a little while ago, and man, what a great young man! Just absolutely killing it, saving lots of money. Had a good sized portfolio, but he was so wrapped up in this whole thing of you can make money no matter which way the market's moving. And just, in my mind, he was just set up for complete self-destruction at some point, because statistically you can do that maybe for a year or two, but you can't maintain that. He wasn't managing himself. He was looking for an advisor to do this for him. And there was a firm here in town that was wooing him that, they have all these great skills to know when to get in and when to get out, and access to these fund managers that no one else has access to. And it's a very much a false sense of security, because all this stuff is tracked. This is not like voodoo. This guy does better. This guy doesn't know what he's doing. All this stuff gets reported, right? And so you see that in the SPIVA report every 6 months. S&P comes out. Even an index that has all these actively managed strategies, right? It comes out, and we know that over a 20-year period, 98% of fund managers can't even beat the S&P 500.
If somebody could do it, as you spoke about, okay, all the big firms would be buying that.
Right,
it wouldn't be in a small little firm in Marietta, Georgia, as being the only place in the world that this can be done.
Exactly.
It may start here, but pretty soon it would end up at Vanguard, BlackRock, or Fidelity.
Right. Well, we even see that in BlackRock. BlackRock has their own models. We track those models. Those models aren't any different than any other models that we track. They have maybe a quarter where they're a smidge ahead of someone else, right? But they also have so much turnover in the funds that they're using that they're creating all these negative tax implications for all the trading. And I'll admit, when I acquired this firm in 2007, Mr. Weiser himself was a big time stock trader. And I used the financial crisis as an opportunity to go to each client and say, look, you've been trading stocks. You've had all these crazy strategies. I've looked at all of your tax returns. Your net number is less than what the S&P 500 is, because he didn't carry bonds or anything like that. It was a pure stock firm. And I'm like, you can buy the S&P 500 index. You're going to have no more big tax bills, and you're going to have a higher rate of return. What do you think? And everyone was like, sign me up. And we had an amazing transition. I think it was over 98% of client retention during that time period, and really no losses of clients during the financial crisis. So it was a crazy time period for me as a manager. But we're able to show people that sometimes you have to take the punches and the volatility. And people who are offering something different, been doing this for 23 years. It's because they're gaining off of something. I saw a great Facebook ad here recently with a young lady in California. She's Investopedia's top 100 advisors, which, by the way, has nothing to do with your advising ability. It has everything to do with how many Twitter followers you have. That's the main criteria. Yeah. It's how influential you are as a financial advisor. And what was interesting about it is that she says, oh, if your financial advisor has told you buy and hold and you have to focus on the long term, it's modern. You need a modern financial advisor for these times. And then she says, there's a whole new U.S. currency that's being touted. Okay, time out. This is true. There is, in the cryptocurrency world, the U.S. government is experimenting with a digital dollar. That's not a new dollar. That's not a new currency. It's just your dollars are no longer in your billfold. Your dollars are on your phone. That's all it is. It's no different than Apple Cash, except sanctioned by the U.S. government. So she took a half truth and she's trying to twist it, right? Then she says, we have strategies that can guarantee that you're not going to lose money. Okay, only time you can say that is if you're doing what, Brad? Guaranteed not to lose money.
Well, it's you're in a bank where you're
annuity.
Okay, well, you can lose value, but they'll replace it. The only guarantee is in the Federal Reserve system.
Well, very true, very true.
BIC, yeah.
So you start looking into what she's doing, and basically she's selling annuity products and index annuities, which are the worst possible kind of annuity. So there's never a free lunch. So when you think about how do we not, so 2023 is supposed to be a horrible year, and you're thinking, how do I manage this risk? How do I manage a recession? It goes back to cash on hand. Keep your cash at appropriate levels for your needs, so that if you need money, you don't have to go sell your stocks. If you need $20,000 to fix the roof and the air conditioner and whatever, your car, you should never have to go to your portfolio. That money should be invested. You shouldn't be invested at all if that's what has to happen, or that money shouldn't be invested.
Right. That should be set aside as an emergency fund.
Correct.
Okay. That can be utilized for these one-off expenditures.
Correct.
And then over time, you replenish it with current income, et cetera.
Right. Current income or dividend income, or you get to sell the stocks at a high in the future.
Yeah. Well, we know that, historically that over longer periods of time, we've done the research on this, and in over 20-year periods, you've never lost value when investing in the market, right? Over 20-year periods. And if we're planning for 30-year periods, it's pretty much, there's a guarantee that you're not going to lose money. Well, even at
10 years. 10 years, the worst case scenario is it broke even.
Right. So, I mean, it's just amazing what time can do for you.
Right.
Look, when people and investors are looking at the market and they're looking at the ups and downs and they're experiencing this, they see it as a flaw, that it's a flaw in the markets that they lose value.
Yeah. Or they just hate losing.
It's a feature.
Right.
Okay? Because the volatility in the markets, and it needs to be managed, but nonetheless, it's preparing itself for the next leg up. Okay. Historically, every downturn in the market was simply preparing investors for the next leg up in the market. And that's the way the market moves. It moves in these fits and starts along the way. And you need to be in at the bottom in order to have the greatest gain
The greatest gain, yes, but we've already talked about this in prior episodes, but the Vanguard, when is the best time to invest your money? Even if you bought at the all-time highs every single time, you still made money.
You still made money. But when it goes down into those dips, you want to stay invested because from that point forward to the next market top is when you make the most money.
That's correct. So for our listeners who are still working, when the market's down, that is an opportunity.
Yes.
And that's when you put in as much as you can.
That is a feature that the market is offering.
During that COVID drop, we had people front loading their 401ks, doing all kinds of things to try to get as much money in as possible. And that ended up being a pretty big gain in 2020 in the end. So, I feel like we're kind of jumping all over the place a little bit, but the bottom line is that there's really no secret portfolio hedge. The best one and the cheapest one, and I was hired probably 10 years ago. I was hired to do a project of someone wanted not to manage the money, but to say, so we want to hedge our risk. What's the best way to do that? You can buy short-term treasury ETF from Vanguard or from BlackRock. It's going to cost you 10 basis points, 15 basis points?
Very low cost on a management fee.
0.1 or 0.15%. It's not going to get any cheaper than that. You can trade it for free, and you can just add it to the portfolio in replace of stock. Not as a timing mechanism, but just say, I want to cut down half my volatility. If you're 100% stock, then you can put in 50% short-term treasury. But again, you have to make sure that the entire portfolio can still meet your long-term goals. And that's where the planning comes into place. And you're running a Monte Carlo, looking at 1,000 different possibilities of market performance, determine if that's your best risk. That's what I love about our planning software. Our planning software actually tell us that. They'll say, hey, if you get too conservative, this plan doesn't work anymore, and this is your threshold.
Right.
You get too aggressive, then it has to build in too much of a reserve. And so it kind of gives you a top limit threshold with this huge gap in the middle where you can kind of tailor it to people, how people feel. So, well, thanks for listening to today's episode. If you're interested in learning more about Wiser Wealth Management or want to schedule a consultation to meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com, or you can click on the link in the episode notes. We also have episode 101, 191, all covering portfolio diversification and performance benchmarks for your portfolio. But most importantly, episode 91 is your behavior affecting your portfolio. That's really big. Sometimes we think we're the smartest people in the room, and then data says otherwise. So focus on the data, focus long term. Thanks for listening.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening, that way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore.